Good morning and welcome. Thanks for tuning in to another one of our webcasts, your chance to ask questions to our Chief Investment Officer. I'm George Mitten, investment writer here at Nutmeg. As usual, I have James McManus, the Nutmeg CIO, here at the other end of the line. He's going to give a short presentation. This week, it's a bit of an overview of the markets, and then a look at some of the issues around socially responsible investing. We'll then move into the Q&A session. As ever, if you've not submitted a question yet, or if something occurs to you while James is speaking, pose it to us using the Q&A feature here on Zoom. We'll try to answer it today, and if not, we'll put it on the list for next week. This webcast is being recorded and will be available to watch again if you like. You'll also be able to share the link. If you're not yet a customer, but you're interested to learn more about us, then welcome. My colleague Cully Samra would be happy to speak to you personally to answer any questions you might have. That's enough from me. I'll now introduce James. Over to you, James.
Thanks, George, and good morning, everybody. Thanks for joining us for another Wednesday morning webcast. And as always, thanks for trusting Nutmeg to manage your investments. Here's today's agenda, as George alluded to. Firstly, we're going to look at what's been happening in major financial markets since our last webcast in the middle of April, and how financial assets have performed towards the end of the month of April and the beginning of May. We'll then look at socially responsible portfolios and how they've performed of late and how they compare actually in terms of their environmental, social and governance aspects. And then we'll also briefly provide an update on how our portfolios are currently positioned, and on our current thinking, and before we move on to answer as many of your questions as possible. So let's get straight to it. What has been happening in the 2 weeks since we last held a webcast? Well, as always, it's been a busy few weeks in financial markets. April actually turned out to be a very good month for equity markets on the whole, particularly for investors who favored the US equity markets, such as ourselves, with the US stock market, the S&P 500 index delivering its best month of returns since 1987 at just over 14%. Now, the picture is not as rosy elsewhere, however, with the UK and the Japanese stock markets delivering only around 4%, and Europe 6.5% for the month. But on the whole, positive returns for equities in the full month of April, and that trend has continued, albeit in slightly more muted fashion in May, where we've seen global stock markets return about 1% for the month so far. So the good news is for Nutmeg investors that their patience and discipline after what was really a tough 2 months in financial markets in February and March was rewarded. April delivering the best month in absolute return terms for Nutmeg portfolios since we started managing money back in 2012. Typical Nutmeg medium risk portfolios now retraced about 50% of the losses since the sell-off began in February. Another asset that was very volatile at the beginning of April was the global oil price, and which, as we discussed at one point in April last time, had turned negative in the front month future. And oil prices have stabilized somewhat since then, around $30 a barrel for Brent crude. And that's really been on the basis that markets have been encouraged by the progress that has been shown have been made in opening economies and the effect that will have on oil demand. We've also seen fears over the lack of storage dissipate in the US, particularly as inventories began to fall there. And sentiment improved actually in the latter part of April as China boosted its oil imports. However, the major oil players globally are still warning that the industry might not be out of the woods yet. Just this week, the CEO of BP warned that oil demand might be structurally lower going forward if some of the loss of demand is permanent. So it's likely we won't see a return to the oil prices we've seen previously short term, but some stabilization in the price is a positive for wider markets and for market volatility. Now, away from oil, we've continued to see companies themselves report earnings for the first quarter of the year and provide guidance on the quarters ahead. Or in some cases, actually withdraw that guidance for the quarters ahead. So in the US, we've had about 85% of companies in the large cap market, the S&P 500, that have now reported their results for the first 3 months of the year. If we take the blended earnings decline, that is the actual results that those 85% of companies have delivered, and then the estimated results for the remaining 15%, it's looking like an earnings decline in the first quarter of somewhere around 14%. And if 14% were the actual decline for the quarter, then that would mark the largest year-over-year decline in earnings since the third quarter in 2009. So a sharp declining earnings as expected, but actually the expectations are that it's the second quarter results where companies will really start to feel the slowdown. It's really important to remember that a lot of the lockdowns, a lot of the damaging restrictions on activity didn't actually occur, particularly in the US, until midway through the first quarter or later in March. So, interestingly, we're seeing a number of companies withdraw guidance for the rest of the year, and that really is also a reflection of the uncertainty that still exists around what the operating environment might be in the second quarter, and in fact, the second half of 2020. Away from companies themselves, at a macroeconomic level, we've continued to get an insight into what's happening at the macroeconomic level for various economies. Today, we had the news that the UK has gone into recession. That was pretty unsurprising for markets. But what was the notable news of the past week or so has been the US employment rate rising to a post-war high of 14.7%. That's 20.5 million people now that have lost employment in the US. It's a phenomenally high number. And it's important to remember that there are, humans behind every single one of those statistics. And the same rate there for unemployment peaked around 10% during the global financial crisis. So 14.7% is really quite a high number for US unemployment. Worse than that, the Treasury Secretary, Steve Mnuchin, has also warned that it might get worse before it gets better. And there are some forecasts for May which will put that figure closer to 20%. Again, it's a really astonishing figure when we look back and think about US unemployment being at almost its lowest levels in over 50 years at the end of 2019. If that figure reaches 20%, we're talking about 1 in 5 Americans being out of work in this period. We're also seeing the average weekly hours worked by those that are still employed decline. But it's really important also to understand that a lot of this unemployment is still expected to be temporary. That is, when the businesses and the economy reopens, there's the expectation that many of these people will return to the workforce and return to the workforce rapidly. That's also shown in the sectors that are affected. So when we look in the employment report, it's really the leisure, the hospitality sectors, the retail sector, the construction sectors that are seeing the most noticeable reductions in unemployment. I'll give you a stat here as well. Leisure and hospitality sectors in the US alone in April saw a 45% reduction in employment. Again, really historically large numbers, and it really reflects the constriction on activity that's still in place. Again, another caveat, it's worth noting that the groups that are eligible to claim employment insurance have actually been expanded. So, more people are able to actually be deemed unemployed under these figures and to gain access to benefits. And actually the employment benefits themselves have also been expanded. So the policy has really been enacted quickly there to help cushion the effect of that historical unemployment, however temporary it may be. From a policy perspective, we've also continued to see support measures implemented and extended globally. Just yesterday, the UK furlough scheme for employers was extended to October. So that's going to provide much, further support for businesses to keep employees on the payroll, to keep that unemployment number from rising rapidly in the near term. We've also seen the Federal Reserve start a number of programs. Most notably, it started its secondary market credit facility this week. That's the buying of corporate bonds directly and also via ETFs in order to support the corporate bond market and to support liquidity in that market. Close to home in Europe, though, we've actually seen the German constitutional courts throw a bit of a spanner in the works of the EU's policy response by ruling that the German government and also some of the EU's top judges have failed to properly scrutinize the ECB's bond buying program. I think this really tests the independence of the ECB, and that is something that's been enshrined in law since the ECB's creation. It hasn't really been tested up until now, but I think investors really will be hoping that there's no further escalation here, because the worry it creates really is over the ECB's ability to enact stimulus programs, and that couldn't come at a worse time for the European economy that's already really struggling. So once again, it's bringing political risk back to the forefront of European investors' minds. And as I said, I think investors will really be hoping that there's a de-escalation between the German courts and the ECB there. Actually, away from coronavirus, we've seen some familiar friends also come back into the wider investors' focus in the past month or so. Those political issues that from time to time come to haunt markets. If you cast your mind back to the beginning of February, it was really the US-China trade war, it was the US election, and the potential for a Democratic candidate to prosper there that were really occupying the category of things that keep investors up at night. And as we move towards that normalization of economies and actually also towards the US November election date, both of these topics are beginning to come back to front of mind. Brexit is also back on the agenda. We've spoken about that in recent webcasts, with the negotiation having been delayed and with the UK fast approaching its June deadline for that further extension to the transition period. And as discussed previously, the current crisis has also brought European politics, and in particular that fundamental divide between the northern and southern European nations and the divide we see in their economic prospects really back into investors' focus as we understand what the policy responses will be in Europe and how Europe will cope with this crisis from a monetary and fiscal perspective. Lastly, obviously all investors remain keenly focused on the journey to normalization in economies. Equity markets have really been buoyed by the progress so far, and the expectation that this issue will be a temporary one. But a word of caution here: I think there is no playbook per se for the reopening of economies. We're seeing different approaches in different regional locations, and it really will be trial and error. And as we're already seeing this week, there are going to be further outbreaks that pop up that are going to need to be controlled, as the ones we've seen in South Korea and back in Wuhan in the past 7 days have shown us. And as such, we don't believe the path is going to be linear here. So sentiment has improved, but we do expect there to be bumps in the road as we move into the second quarter and that normalization of economies. So where does that leave us year to date? Well, if you've joined us in recent weeks, you'll be familiar with this chart. It shows you a range of different investment assets plotted by their returns so far in 2020 relative to their long-term volatility. And what we can see, much as we've seen in recent weeks, is that most assets actually have performed relatively in line with their long-term risk profile. That is, the higher the risk, the larger the losses. And as with recent weeks, government bonds are still the standout performers year to date, but actually investment grade bonds, both in the US and in the UK, are now back towards positive territory for the year, given their performance in recent weeks, particularly as the Fed and the ECB have stepped up their bond buying programs. Gold has also delivered strong returns relative to its long-term volatility, whilst emerging market equities remain the most volatile and amongst the worst performing assets year to date. Again, as with recent weeks, we plotted a number of Nutmeg portfolios here in the green. So there's the fully managed risk levels 4, 6, 8, and 10. And the point I really want to underline here is one of the value of diversification and asset allocation, spreading the risk across global markets and across a broad range of asset classes, and really helping reduce that risk when markets are volatile, but also allowing us to participate in market rallies. So the next couple of slides really look at a topic that we are very passionate about at Nutmeg, and that is socially responsible investing. And it's also a topic that many of our clients are passionate about, and it's a topic that we've received a number of questions on in previous weeks. So hopefully the following slides will help to answer those in a brief way. So as a reminder, what is socially responsible investing? Well, our socially responsible portfolios are fully managed by our investment team. They reflect the same asset allocation views as our fully managed portfolios, but they are invested in funds that have an explicit social responsibility focus, and that is that these portfolios will be overweighted to companies that have strong sustainability profiles, strong environmental, social, and governance profiles, whilst avoiding those that engage in controversial activities such as weapons manufacturing, as gambling, or, for example, controversial environmental activities such as thermal coal production. Now, invariably, the first question that investors always have when it comes to thinking about SRI portfolios is how have they performed? And well, the full performance track record is available for each risk level on our website. We also have a blog on Nutmegonomics that looks at our performance expectations for these portfolios over the long term based on our back testing. But what I've given you here is just a snapshot to give you an indicative feel as to how they've performed since we launched them back at the end of September 2018. And so this is the relative performance of Nutmeg SRI portfolios at risk level 6, at risk level 7, risk level 4, risk level 6, 8, and 10, relative to the ARC benchmark. So as a reminder, ARC benchmarks allow us to see what the average wealth manager has delivered in terms of returns at a given risk level over time. And what you can see is that both in 2019, since inception at the end of September 2018, but also year to date, as a whole, socially responsible portfolios have really delivered strong returns when it compares to the returns of an average wealth manager's non-socially responsible portfolios. Now, I have to caution that these are short periods and that we have previously stated that whilst we don't expect there to be material performance differences in the long term, we do expect there to be short differences in the performance of SRI to wider portfolios, both good and bad. But I think this gives you a snapshot of how strong the relative performance has been for companies and for portfolios that deeply ingrain an ESG approach over the past 18 months and particularly year to date. So the next slide really shares some more detail on the drivers of this underlying performance. And the table on the right-hand side, in fact on the left-hand side, shows you the relative performance by region of the stock indices that incorporate the SRI focus relative to the wider stock market index. So for example, in the US here, what we're looking at is the performance of the US Socially Responsible Index or Fund relative to the wider US index. And what you can see from the table is that for the majority of markets, the past couple of years has really rewarded an SRI focus. And in fact, in 2019 and so far in 2020, only in emerging markets, and in particular in emerging markets in Asia, would adopting an SRI approach actually have detracted from your performance. And the US, of course, is the world's largest stock market. It accounts for around 65% of the global stock market. And so its strong performance counts significantly to the performance of the global SRI index overall. And you can see that in the chart on the right-hand side. That shows the relative performance of the global index that's socially responsibly focused against the wider global stock market. And as you can see, since 2018, the SRI focus has really been rewarded. But particularly in 2020, the recent strength of that outperformance has shone through. But it's actually in Europe, back in the table on the left, that I want to draw your attention to. You know, Europe is one of the markets where ESG considerations in investing have long been prevalent, and it's also where we see the most consistency in outperformance. So, you know, SRI indices in the European Monetary Union area of investment would have outperformed the wider EMU index every year since 2015, but it's not as straightforward as that in other regions. So in markets such as Japan, UK, Asia Pacific, in the past few years have been much more mixed. I mentioned those short-term deviances in performance, and I think the UK is really a good example of this. So the UK's outperformed quite significantly this year, up around 6.5% relative to the wider stock market. But actually in 2016, it finished the year over 10% behind the wider UK index. So we do expect there to be deviances in performance short term. The most keen-eyed amongst you actually will have noticed that in recent months, we've started to incorporate SRI holdings also into our wider fully managed portfolios. And really this is around a continued belief that the ESG is a factor that is going to be rewarded in companies in the medium term. But also a belief that one thing that will also be rewarded is a lower carbon exposure in portfolios. So by integrating those holdings into our wider fully managed portfolios, we're able to lower the overall carbon exposure, but also tilt the portfolios towards those companies with preferential ESG profiles. So that's the performance aspect. And again, there's much more detail on the website, so please do go and explore those full performance track records. But many investors in SRI portfolios are also focused on aligning their investments much more with their personal values. So, how do these portfolios really compare against those environmental, social, and governance metrics that I've been talking about? Well, here's a quick table that will help you visualize this. This is a comparison of our socially responsible portfolios against a equivalent portfolio of exactly the same asset allocation, just without an SRI focus. So, this helps you really understand the relative improvement in terms of these ESG metrics for the portfolio that you get by adopting an SRI approach. And these are the same scores, I should add, that are available at all times within your account, within the portfolio pages. We work with a fantastic company called MSCI to help bring these to life in your portfolios. I've simply summarized them here as a snapshot across all portfolios. But what you can see is that there's a really significant improvement across nearly all ESG metrics and across all risk levels. So as you can see from the table, SRI portfolios as a whole have a significantly lower carbon intensity, a carbon intensity on average about 17% lower than an equivalent non-SRI portfolio. They stack up better across a whole range of different environmental, social, and governance scores, and at an overall ESG score basis, nearly 20% on average better. So if you are interested in how you can better align your investments, one of the key financial commitments that you're going to make over your lifetime with your personal values, if you're interested in aligning your pension much more with a lower carbon society, then I would advise that you take a look at the information that we have available on the website. We're always happy to provide any more detail on any of these metrics as an investment team. And we also have a number of different blog articles on Nutmegonomics at the moment that explore, in particular, the carbon aspects and environmental aspects, but also looking at some of these social aspects such as diversity, labor standards in businesses. And it's an area that we're seeing increased questions and interaction from customers on. So I guess a final word on SRI, and that is really that we continue to believe that we're at a tipping point when it comes to the adoption of environmental and social and governance criteria in investment portfolios more generally. But we think that socially responsible indices really offer an interesting alternative to the traditional market indices, and there are many reasons why we think investors might want to incorporate a socially responsible approach. Some of the reasons are listed on this slide, but I think put simply the change, the world is changing rapidly. Forces such as climate change, the demographic changes that we're seeing, the clean energy transition that we're undertaking, and global policymakers focus on a much fairer society that aligns or better aligns with the sustainable development goals that are all trends that we're likely to see reward companies with preferential ESG profiles in the future relative to those that have poorer ESG profiles. And I think even the most recent COVID crisis has sharpened our focus on sustainability issues as a society. So we continue to believe that in the future, all investment portfolios will have a really strong ESG focus. We're continuing to build out our research resources on ESG in that regard. That's a really quick 4 slides on SRI portfolios. So if you are interested in learning more about this style of investing, please do visit our white paper. Keep your eyes on Nutmegonomics, where there will be more content on this topic in weeks and months to come. But visit the SRI homepage and please do read the white paper if you're interested in any of these topics. So I guess I want to finish by providing a bit of a brief update to how our portfolios are actually currently positioned. So this is talking specifically to our fully managed portfolios, both the standard fully managed portfolios and also the socially responsible portfolios. When it comes to equities, we do remain slightly underweight our long-term levels of holdings in equities. There's still a significant amount of macro uncertainty at present. And although we think it's likely that we're unlikely to revisit the lows of the sort of March market panic, we know that market recoveries are typically far from linear. And the unpredictability of the issue we face and the normalization of economies means we're happy to be slightly cautious at this time, because we think there will be undoubtedly challenges ahead. And as I mentioned in my first slide, bumps in the road as we look to reopen economies and get the economy back on a solid footing. Within the equity mix, we still favor large cap companies, particularly in the US and in the technology sector. We've also added to global and US equities with a socially responsible focus. We do remain underweight the UK. We remain underweight Japan and emerging market stocks, as well as small cap companies globally. We've moderated that UK underweight actually yesterday slightly because of the extent of UK underperformance. But we are still favoring US markets. We think the economy there was the strongest coming into the crisis. We think that the Federal Reserve has been amongst the policymakers that has made a commitment that's unquestionable, and we also think that market is home to some of the growth leaders in those technology stocks. When it comes to fixed income assets, we're actually also an underweight duration. That's the interest rate sensitivity of our bond mix, and that really reflects the risk reward of the currently really low levels of government bond yields. So what we're preferring to do there is hold a small amount of cash rather than hold all of our underweight equities in government bonds. That really reflects the risk reward balance of those low yields and the potential for yields to rise and cause prices to fall, even in spite of a lower for longer interest rate environment. In corporate bonds, we're favoring the higher rated element of the spectrum, so what we call investment grade corporate bonds, those with higher credit ratings both in the US and the UK. And we've also recently bought a small position in fallen angels, and this is a term for bonds that were formerly rated investment grade but have now fallen into the top tier of the high yield market. And we think we'll see much more of these bonds move from being investment grade into the fallen angels spectrum. They're still relatively high quality companies, even though they are now high yield. The program that has been launched by the Federal Reserve is really a reflection of the need to support that element of the market, and the fact that the Federal Reserve itself expects a number of companies to be downgraded as they face a more challenging economic environment. But we think some of those companies really offer an attractive yield whilst remaining at the higher quality end of the high yield market. And then finally, we also reduced our exposure in EM sovereign debt. So this is an asset class that is really likely to face some significant headwinds in the medium term due to the risk of rising sovereign distress and default in emerging markets. So that really concludes our prepared slides. So George, maybe it's a good opportunity now to move to questions.
Absolutely. Thank you, James. Thanks for an interesting and, as always, very thorough presentation. The Q&A session, we had one, this wasn't submitted today, this came recently, but it's a really good question. I wanted to put it to you, James. I've been looking forward, in fact, to posing this question to you. This one comes from Sorab, who asks, can you help me understand how much of the personal money does the CIO, that's you, James, invest via Nutmeg? Do you have all of your ISA, all of your pension in Nutmeg? Also, what is the cost to you if the investment strategies fail to perform? How are you compensated or measured on success? James.
Okay, so yeah, I mean that is a relatively simple one in some aspects. So I don't have any investments outside of Nutmeg. I have an ISA here, stocks and shares ISA. That's split across two different pots. Both of those are socially responsible if you're interested. And I also have my pension here. I transferred, when I moved to Nutmeg, two pension pots from previous employers to Nutmeg also. So what money I have invested and saved actually is all here at Nutmeg. And what you would find is that that's very similar to many Nutmeg employees and certainly the wider investment team. What is the cost of getting it wrong? I guess in simple terms, probably my job for a start. But I think to talk to the point in terms of rewards, everybody at Nutmeg is paid a salary, obviously, and they also have some ownership of the business in terms of share options. We don't have a bonus culture here. We're not a business that pays bonuses. But our investment portfolios are our products. So, their performance or success, if you like, is entirely aligned to your success in reaching your investment goals and our success in building a business. So, one of the principles of making sure that everybody who works at the business has, some ownership of the business means that everyone's aligned to delivering the best possible outcome for customers. So, I think it's worth thinking about what that means also on a personal note. So for me, many of my family members, many of my close friends are clients too. Even my 2-year-old godson now has a junior ISA with Nutmeg. So, what does success mean for me? Well, personally, it means helping many of those who are closest to me actually achieve their financial goals too.
Thank you, James. Thanks for a very upfront and honest answer. But I can assure you, listeners, that I think it was sincere. Many of us at Nutmeg do invest all of our investments with Nutmeg. And when I moved here, I also did the same as James and consolidated my existing pension pots. It's just convenient having all of those in the same place, I find. Here is another question from Tim. Very difficult times at the moment, says Tim. What's your best current thinking on when we may be financially back on track with our investments post COVID-19 levels? How have your plans changed to accelerate this, James?
Okay, well, if you're a long-term investor, then you shouldn't necessarily consider yourself off track. I think market volatility is part of the course when investing. And that's why it's so important to be disciplined and to stay the course in order to meet your end investment goals. And we've written about this a lot in the past on Nutmeg Economics. In fact, there's a brilliant blog that's all around. I think it's actually called "Increasing Your Chances of a Positive Return," and it's all about just that. And it looks at global stock market data back to the 1970s, and it takes the example of picking a random day during that period and looking at what your chances of a positive return would be. And that chance is just over 50% as a positive return, as a chance of making positive gains if you held for that one day. That's very similar, obviously, to tossing a coin. But the point of the article is that it looks at how long-term investing really dramatically increases your chances of making positive returns. So it then goes on to show you that if you'd invested your money for just for 1 month during that same period, then your chances would have increased to around 63%. For a year, your chances would have increased to about 78%. And then over 10 years, your chances increased to about 99%. So I think, when it comes to what we're doing to accelerate, the recovery of some of the losses, we always position our portfolios to reflect that balance of risk and reward in our view. And we've seen a retracement of about 50% of the losses since the initial sell-off at the end of February. And this is quite typical in a market sell-off. That's why in previous webcasts, we've talked about the importance of staying disciplined. We've talked about the concept of upside volatility as well as downside volatility and the coincidence of best and worst days and months in markets. We do remain slightly underweight equities, as I just talked about. We continue to see the potential for secondary effects to play out near term. But we've also rotated holdings in the portfolio to prepare for a slightly different environment ahead. So, less smaller companies, higher quality corporate bond exposure. We're favoring the US market, where we think the policy commitment can't be questioned, where the economy came into the crisis in most robust shape, and where we think that many of the world's largest technology and growth companies are listed. And I think again, it's unlikely. We think it's unlikely we'll revisit those market lows of the March panic, but the unpredictability of what's going on at the moment means that we're happy to be cautious. And I think it's worth noting that although we've been underweight equities as a whole in this period, we've actually delivered returns that are relatively strong in the equity portion of the portfolio, and that's been due to our bias to US equities. So we've had quite a large overweight to US equities and quite a large underweight to UK equities as well as Japanese equities, and a slight underweight in Europe and emerging markets. And when we look at the the period where markets have rallied here, say from the 23rd of March, which was the real bottom in markets. Over the, from the 23rd of March to yesterday, the US markets delivered just over 31% in returns. That compares with the 18 to 22% that's been delivered in the UK and in Japan, Europe, and emerging markets. So, the US has really delivered for us. It's allowed us to remain underweight equities, but also to still deliver strong returns in the equity portion of our portfolio. Again, we favored US technology stocks. We added to US technology stocks, in the midst of the volatility. The technology stocks have delivered nearly 33% in that period, so significantly outperforming on a regional basis, and that's really helped us, as you said, as the question I think phrased it, accelerate the portfolio's retracement of some of these losses.
Thank you, James. Let's move on to a question from Mark, who asks, how have both the managed and the fixed allocation portfolios fared during the recent coronavirus outbreak? How have they performed well against industry benchmarks, James?
Sure. So the best way to view the performance of our portfolios is always via the website. You'll be able to find the most comprehensive view of performance there across different portfolio risk levels and against competitive benchmarks. I can provide a brief comment here, but I would urge you to visit the track record section of the website if you've got further questions, and to understand also how these performance figures are calculated. So I do need to stress from a regulatory perspective that we're talking here about just a short-term period in this year, and that the performance of our portfolio should always be judged over a period of years rather than months, which is again why we've previously discussed on why focusing solely on short-term performance can lead to the wrong conclusions. But so for 2020 year to date through the end of April, our fully managed portfolios on average are just slightly behind ARC benchmarks. They're behind by around 40 basis points on a weighted basis. So that's accounting for the proportion of money that's invested across different risk levels at Nutmeg. Or if we just take a simple average basis across all the portfolios, we're behind by about 20 basis points. So performance more or less in line with that of the wealth management industry average, where as a reminder, the minimum investment for many of those wealth managers is typically in the hundreds of thousands rather than the hundreds of pounds. For our fixed allocation portfolios, they're actually slightly further behind ARC year to date than the fully managed portfolios. So on a weighted basis, about 1% further behind on average than the fully managed portfolios. And on a simple average basis, again, around 70 basis points, so 0.7% further behind. So taking them to just about 1% behind on average on ARC. So I do have to, again, caveat these figures and say that whilst those figures are after Nutmeg fees, the ARC numbers at this stage, the asset risk consultants, benchmarks, which is the aggregation of other wealth managers' portfolios, they are estimates at this stage. So because the work hasn't been undertaken to collate and ratify all those returns from each of the wealth managers yet, they are still estimates. We should get the confirmed numbers later this month for the first quarter of the year, and we will update the website with those as soon as we get them.
Thank you, James. On the topic of performance, we have a question here from Shuna, who has a socially responsible portfolio. Shuna is curious to know which tracker to follow to monitor the performance of that portfolio over the course of a day. Now, I know that Nutmeg is really about long-term investing, but if someone does want to see hour by hour how their portfolio is likely to have changed, what would you suggest for Shuna, James?
Yeah, so thanks for the question. The performance of obviously the performance of your Nutmeg portfolio will be visible daily in your account. We update the prices of the holdings at the end of every single trading day. So, that doesn't necessarily mean that you should always be checking your account every day. Of course, if you're focused on the long term, then those day-to-day movements shouldn't really bother you outside of your own interest in markets. But it's the returns that are delivered over the medium term to long term that are really going to matter. But we understand that that some clients have a particular interest in the markets, and therefore you are going to want to see what's going on intraday, and that is, when we say intraday, that's within the trading day. I would say that this is fraught with problems because no Nutmeg portfolio consists of one holding. So our portfolios are built from the very start with diversification in mind, and therefore no one strategy is going to be representative of the performance of the overall portfolio. And also the mix of assets in those portfolios is going to change depending on what risk level you are invested in, but also on our, depending on our team's view in our fully managed portfolios. I think that, that said, for most of the higher risk portfolios, if you're looking for a bellwether or a proxy, particularly for the socially responsible portfolios, then the global stock market is probably your best bet. In socially responsible, for example, I would pick out a tracker such as the ticker would be AWSG. It's the UBS All Countries World Socially Responsible Index hedged to GDP. So that's a UBS ETF that is actually in our portfolios. It tracks the performance of global stock markets with a socially responsible focus. So that's going to give you an indicative feel for how global stocks with that focus are performing on a given day. But it is important to recognize it's only an indication, and portfolio performance, of course, will differ from that, but it will be available daily after the market close in your account.
Thank you, James. We just have time for one more question. There have been a number of good questions that have come in during the session, and I would like to cover some of them, but we're running out of time. So if your question hasn't been answered today, please do tune in next time and we'll try and answer it then. This question is from Jonathan. Even before the COVID-19 crisis, the average price to earnings ratio of leading stocks was relatively high by historic standards. Is this because of ultra-low bank interest rates and bond yields driving money into stocks? And if so, are we in for a nasty surprise when interest rates eventually climb again? James. Are you there, James? I think we may have lost you.
Sorry, I actually went on mute there. Schoolboy error. So I think this is a question about valuation. So, you're right in stating that there are segments of the global stock market, certainly sectors, regions, companies that had high valuations pre the COVID-19 crisis when looking at price to earnings ratios. But given that several markets were at or very close to their all-time highs, that probably shouldn't surprise you too much. I think price to earnings ratios are, if you're not familiar with them, they're one of a number of valuation measures that investors can use to form a view about whether stocks are undervalued or overvalued. And price to earnings is one of the most widely used valuation metrics. It really provides a view to what the current price means relative to a company's earnings, either past or future. So it's the share price divided by the amount of earnings per share. So in other words, a low price to earnings ratio means you are paying less in price for more earnings, whereas a high price to earnings ratio could suggest that the company is overvalued relative to its earnings. But I think it's important here to understand that there are multiple dynamics to it, because a high price to earnings ratio could also mean that investors are betting on growth, and in particular that company will grow faster in the future than its peers. So in fact, they're actually willing to pay a higher price today with the expectation that also there will be an increase in earnings later on. So, the interpretation of a price to earnings ratio is really important. And again, conversely, when you've got a low price to earnings ratio, some stocks might look really cheap, but that's actually because their earnings growth outlook could be really poor. So it's important to take valuation measures, all valuation measures, but particularly price earnings, not to take them in isolation. And this is an area, as I've probably alluded to, that is full of pitfalls. And if you take forward estimates of earnings, for example, a forward price to earnings is essentially taking the current share price and taking an estimate of what the earnings growth is expected to be. Now, in the current environment, the level of uncertainty means that many companies are withdrawing that guidance around their earnings. And that's going to make estimating earnings a very difficult task indeed. So, valuation metrics really need to be viewed through multiple lenses. An investor needs to have a market outlook, and they also need to be viewed on a relative basis to that of their peers. That is comparing companies within their own sector, against the peers that they're operating against. So, they also need to be viewed in the context of the wider macroeconomic environment. Many things will affect the price that somebody is willing to pay for an asset. I think the question alluded to this. For example, when interest rates are lowered, that means the cost of companies financing themselves generally is going to decrease, and therefore that should be a positive for earnings growth. That it also means the opportunity to earn rewards in bonds is going to be reduced. Your risk-free rate, if you like, has fallen, and therefore that is going to encourage more investors to take more risk, to purchase equities, which in turn might increase the price. We see a similar effect also in inflation. When inflation is lower, the opportunity to earn a real or after inflation return actually increases, and thus investors might be willing to pay more for that growth. But it's really important to also understand, why these dynamics are happening. So let me give you a simple example here. At the moment, we favor large cap technology stocks in our portfolios, despite the fact that they have relatively high valuations when compared to other markets. That's really because we think in the current environment, we believe they're still really well placed to deliver that growth leadership. They're well placed from a financial perspective. They've got typically large cash piles. They've got strong remote operating capabilities for a world in which we're all needing to work from home and operate our businesses remotely. They've seen rising recurring revenues in areas such as software in recent years. So their revenues are more potentially predictable than they have been in the past, and also lower interest rates are only going to increase their attractiveness from a valuation perspective. If you compare that to a sector such as airlines, where we've seen valuations fall really markedly, how do you see airlines in the current environment? Well, we personally would be reluctant to make the case that just because their valuation is really attractive, that those companies now offer significantly better value in the short term. And that's really because their business models just don't appear well positioned for growth in the medium term environment. So, there is an element of understanding how valuation also relates to what's going on, and context here is really critical. No more so than actually historical context as well. So, the US stock market, for example, is typically much more expensive on a valuation basis than, say, the European stock market, but it's also home to many high growth mega cap technology companies, which then help justify that valuation. So it's important to recognize, what's driving the valuations, particularly at an index level, and also what's changed as well in the structure of the market over time. So mega cap technology, for example, in the US, is a much larger part of the market now than it has been over the long term. So therefore, you could create the case that helps justify a higher valuation today if you believe that those companies could deliver growth. I think coming back to the question on interest rates, we don't believe we'll see a rise in interest rates in any major developed market economy in the very near future. Policymakers are focused on supporting an economic recovery, and that means lower interest rates are here to stay. I think that can allow some increase in the valuation of equities near term. Much of that actually we've probably seen already come into the markets in the recent rally. I think when it comes to valuation metrics as a whole, a word of caution about how to interpret them. But we do expect that the investors are going to have to favor equities over bonds in this ultra low interest rate environment. And therefore that is likely to push up valuations in the medium term.
Thanks very much, James. Wow, we've really covered a lot of ground today. So thank you everyone for tuning in and staying with us. That is all we have time for today. If your questions didn't get answered, and some really good ones did come in today, which we haven't had time for, please do join us next time. Now, we have reduced the frequency of these webcasts as the markets have stabilized, and the next one is scheduled for 2 weeks from now. So that's the same time as usual, 11 a.m. on Wednesday, but in 2 weeks' time. We will be sure to contact you by email, and we'll also be publicizing on other channels that will be doing the webcast at that time. So keep an eye on that, and we will inform you and we will remind you as well. I've said this before, but I'd like to mention again Trustpilot. If you've used Nutmeg and if you've had a good experience, a great way to share that feedback is by leaving us a review. You can find the right page by searching for Nutmeg Trustpilot. This feedback is helpful for us and for other potential customers. And finally, I also wanted to highlight our continued partnership with Great Ormond Street Great Ormond Street Hospital Children's Charity. It's a great charity that relies on people's generosity to make a real difference to ill children and young people. We are donating £25 for every Nutmeg Junior ISA account opened. We'll also match any donations you make up to £100. You can learn more about this at nutmeg.com/JISA. Capital at risk, JISA rules apply. Thanks again for tuning in, and we hope to see many of you next time.